everybody. This is Dan Sheridan, and excited to introduce our uh, live new class for 2024. It'll be our 10% class. Plan to make 10% a month on range-bound trades, and these will be typically range-bound trades like butterflies, calendars, iron condors, double calendars, different type of trades like that, some verticals where we're trying to put them on anywhere from 10 to 15 days to 35 days. I mean, we will do some shorter term 4-day stuff. So definitely some diversification in terms of duration and strategies. And the neat thing is we'll do live trades every class. So we'll track the trades, which we do every month. And you'll learn risk management, how to put the trades on. Every trade will follow through. And then when we do adjustments or anything, I will send that out to you. So you get a bit of hand holding, but you're learning the craft. We're doing these trades, and we'll do at least one trade for each class. This starts January 9th, and it'll go 4 weeks. So we'll go January 9th, 11th, 16th, 18th, 23rd, 25th, Jan 30th, and then we'll end on Feb 1st. And again, we start on Jan 9th. It'll run 2 Eastern each day. All the classes will be recorded. So that's 2 Eastern, 1 Central. And then, but we'll start a half hour ahead of time, which will be 1:30 Eastern. We'll call that kind of boot camp. And that's for people who aren't as familiar with the range-bound trading, this type of strategies. And we'll cover a lot of the concepts we're going to cover in the upcoming 10% class to help you with the terminology. So if you're a beginner, that first half hour will kind of get you in the ballpark. But this is going to be a very practical class. We're going to be doing it. Again, if you're a beginner, you'll be doing a very small trade, live trade, or a paper trade. Others can do a bigger trade, depending on your experience level. But we look forward. Oh, a couple, just, and here's an example. This is as of D28. Just looking, this just be an example of what these type of trades even look like. Here's an example of just 2 of the 8 or 9 trades that we would consider in our golf bag. This particular example is a calendar, and this would be a 15-day calendar. And you could see the blue graph here is the expiration graph. And so you could see it's centered at 47.90. I'm selling the Jan 12 47.90 calls 15 days out, and I'm buying my long 7 days further out. And in this case, I'm doing it at the money. That'd be more range bound. So you can see the deltas are under a 1, pretty delta neutral. Here's your graph at expiration in 15 days. Here's your graph today. And over the 15 days, that purple line will be gravitating towards the blue line. You make your money in calendars because your shorts are at an earlier time period, and they're going to decay faster than your longs would be. So calendars are a debit transaction. So you'd like to buy it for 1040. If we're looking to make 10%, which is pretty normal, 10% of about $1,000 would be $100. So if I paid 1040, looking at debit, look to sell it at like 1140. And they're positive theta trades because your shorts are going to decay at a faster rate than your longs because they're 7 days further out. Or positive vega trades, and that way volatility goes up on this type of trade. You can make money. I mean, this is a theoretical. When you look at the Greeks, they're theoretical numbers, and what it means is this is saying that if the volatility of your longs, which in this case is 10.41, goes up a point to 11.41, and the volatility of your shorts, which is 10.47, goes up a point to 11.47. If they both go up a point, you'd make $79. How does that happen? Well, because you're buying more extrinsic value in your longs than your shorts. So if volatility goes up a point, the extrinsic value or juice in the option is expanding, And because you're long the one with more extrinsic value, you'll make that's $79. So we'll go over that. We'll show you how to manage the trade. You can see here's your expiration break evens, where the expiration graph crosses zero. So range bound traders, unlike directional traders, we're trading based on probabilities and decay. So as long as we're within, if this is where the current underlying is, 47.90, this is saying our good profitable area is between 47.40 and upwards near 48.60 here. And so we'll teach you as the SPX starts going outside your profitable areas, like one of those electric fences people have. And, how do you manage it? Do we take it off? How do we adjust it? What adjustment do we use? And this is a calendar trade. And so benefits if volatility goes up. A butterfly trade is pretty similar in graph to a calendar trade, as you see here, but it's short vega. So because you're selling more extrinsic value at the money options have the most extrinsic. And in this case, you could see here I'm selling an at the money 47.90 call. I'm buying an in the money 47.20 call, 70 points in the money. And I'm buying a 48.50 out of the money call, 60 points out of the money. So you can look, my in the money call hedge is 70 points below my short strike. My out of the money call hedge is 60 points up. So when there's a difference in widths from the short to the various longs, which there is here, the upside, there's 60-point difference between the short and the long here. There's 70-point difference. It'd be called a broken wing or unbalanced butterfly. And it's short vega because you're selling more extrinsic value than you're buying, and you're long in the money and you're long out of the money. So if volatility goes down a point from its current levels, and you can see they're different here, you would make $113. It doesn't always work that way. But again, we will teach you these strategies. And again, it'd be very practical, a good way to start the new year learning risk management and the craft of option trading. So we'll see you Tuesday, January 9th. And again, you can check out SheridanMentoring.com and get some more information. Thanks so much, everybody.